Welcome to Audio Growth Library, where we bring you timeless wisdom from the world's most influential minds. In this audiobook summary, we dive deep into a financial classic that challenges everything you think you know about economics, markets, and the role of human behavior in investing. Today, we explore The Alchemy of Finance by George Soros, a groundbreaking work that has redefined the art and science of investing for decades. This isn't just another book about stocks or strategy. It's a philosophical journey into the psychology of markets, the theory of reflexivity, and the raw, unfiltered thoughts of one of the most successful investors in history. But what makes Soros different? Unlike many who try to tame the market with pure mathematics and rational models, Soros boldly claims that markets are not always efficient, and that human perception shapes reality more than we dare to admit. He argues that financial markets are inherently unstable, driven by a complex web of feedback loops between thinking and reality. If you've ever wondered why market bubbles form and burst, how investor bias and fear influence price movements, and how one man turned philosophical insight into billions of dollars, then this audiobook summary is for you. Over the next chapters, we will unpack the core ideas of this financial masterpiece, chapter by chapter. You'll discover the theory of reflexivity and how it upends traditional economics, how Soros uses a real-time experiment to test his theories in the real world, the critical flaws in equilibrium theory, and what that means for investors today, and most importantly, how you can apply these insights to your own financial thinking and life strategy. This is not just theory. This is a powerful lens for navigating uncertainty, making better decisions, and thinking independently in a world filled with noise. So get comfortable, stay curious, and listen till the end. Because by the time this journey ends, you won't just understand the markets better. You'll understand how your mind shapes your reality. Let's begin. Chapter 1. Theory of Reflexivity. In Chapter 1 of The Alchemy of Finance, George Soros introduces us to the heart of his revolutionary philosophy, the theory of reflexivity. This single concept forms the bedrock of Soros's financial thinking and challenges some of the most fundamental assumptions in traditional economics. Let's explore what this means, why it matters, and how you can apply it in your life. Direct hit. What is reflexivity? In the simplest terms, reflexivity is the idea that perceptions can influence reality, and in turn, reality can influence perceptions, creating a feedback loop. Here's how Soros puts it. I contend that financial markets are always wrong in the sense that they operate with a prevailing bias. Traditional economics, especially the efficient market hypothesis, EMH, assumes that markets reflect all available information. Investors are seen as rational actors who process data accurately, and prices adjust accordingly. But Soros sees it differently. According to him, investors don't merely observe the market, they shape it. Their decisions, biases, and reactions alter market conditions, which then feed back into their thinking, creating a constantly shifting reality. In this sense, markets are not mirrors. They are funhouse mirrors, bending and distorting reality based on what people believe will happen. Brain 2 roles: thinking and participating. To better understand reflexivity, Soros breaks down the dual role of individuals in any system, especially in markets. Cognitive function. This is our ability to understand the world. Participating function. This is our ability to act and influence the world. In most disciplines like physics or biology, observation does not influence the phenomena being studied. But in finance and social sciences, observation changes the subject being observed. For example, if enough investors believe a stock will rise, they buy it, and it rises. This is the reflexive loop in action. Chart decreasing real-world example: the housing bubble. Though the book predates the 2008 crisis, Soros's theory perfectly explains what happened. People began believing that housing prices would always rise. As more buyers entered the market based on this belief, demand pushed prices even higher, reinforcing the belief and drawing in more investors. This created a bubble. Eventually, reality couldn't support the illusion, and the system collapsed. Soros would argue this is a textbook example of reflexivity. Perception created a reality which fed the perception until it couldn't. Repeat button positive and negative feedback loops. Soros explains two types of feedback loops. Positive feedback loop. This amplifies trends. When perceptions lead to actions that reinforce those perceptions, like in bubbles or bull markets, we see a snowball effect. Example: a rising stock attracts more buyers, which pushes the price higher, attracting even more buyers. Negative feedback loop. This self-corrects. When markets overshoot, reactions bring them back to a baseline. Example: a stock becomes overvalued, investors realize it, and sell, leading to a price correction. While traditional theory focuses only on equilibrium and correction, Soros emphasizes the instability that comes when positive feedback dominates, often ending in boom and bust cycles. Light bulb key lessons from Chapter 1. Markets are not rational. The idea of rational actors making perfect decisions is a myth. Investors are human, and humans are influenced by emotion, narratives, and biases. Perception can create reality. If enough people believe in a certain market trend, they can make it real for a time. This explains bubbles, manias, and crashes far better than traditional models. Knowledge is imperfect and evolving. No one has a complete view of the market. Every investor acts on limited, biased information. This uncertainty is not a flaw. It's a feature of the system. You can't separate the observer from the system. In finance, the very act of observing and making decisions alters the market. Investors are not neutral bystanders. Test tube practical applications for today. Now let's bring these ideas to life with practical applications you can use in your own financial journey. 1. Be skeptical of consensus. When everyone seems convinced about a trend, whether it's crypto, tech stocks, or real estate, it might be time to pause and reflect. Soros would say, the more widely believed something is, the more likely it is already priced in. 2. Watch for reflexive loops. Start identifying feedback loops in the market. Are prices rising because of improved fundamentals or because people think prices will rise? That difference is everything. 3. Use reflexivity to your advantage. In trading or investing, look for early signals of sentiment shifts. If you can spot the beginning of a reflexive trend before it becomes obvious, you can position yourself ahead of the crowd. 4. Manage risk with humility. Soros admits he often got things wrong, but he was quick to cut losses and adapt. Adopt the mindset that your knowledge is limited and adjust quickly when evidence changes. 5. Apply reflexivity to life. Beyond markets, this principle applies to careers, relationships, and personal growth. Your belief in your own ability can create the actions that make it real or not. For example, believing you're not good enough can lead you to avoid challenges, reinforcing that belief. But the opposite is also true. Closing thoughts on Chapter 1. George Soros' theory of reflexivity doesn't just describe market behavior. It exposes the illusion of certainty in economics. While traditional models offer tidy predictions, Soros gives us a messy, real-world truth. Markets are made by people, and people are unpredictable. His courage to challenge academic orthodoxy and admit the limits of his own knowledge has been a cornerstone of his success, and it can be yours too. In the next chapter, we'll explore how Soros tests this theory in real time, using his own investment fund as a laboratory. It's a bold move that blurs the line between theory and practice, and you won't want to miss it. So stay tuned, and remember, in a world of uncertainty, those who question, adapt, and reflect win. Chapter 2. The Theory of Reflexivity Tested. In Chapter 1, we explored Soros's groundbreaking idea of reflexivity, the feedback loop between perception and reality. Now, in Chapter 2, Soros takes things a step further. He doesn't just theorize about markets. He tests his ideas in the real world with real money. This chapter, The Theory of Reflexivity Tested, is where Soros steps into the arena. It's not just philosophy anymore. It's finance in action. He puts his capital on the line to observe how reflexivity plays out in actual market behavior. This chapter is unique in the world of finance literature. It's part diary, part analysis, and part confession. Soros lets us look inside his mind as he tries to apply abstract theories to concrete traits. The result? A fascinating, honest glimpse into the mind of a master investor. Test tube, the real-time experiment, a financial diary. To validate the theory of reflexivity, Soros began what he calls a real-time experiment, documenting his thoughts, decisions, and trades as they happened during a particularly turbulent period in the financial markets. The diary spans from August 1985 to February 1986, a time of significant global economic shifts. This period saw the Plaza Accord, where major nations cooperated to devalue the U.S. dollar, a massive real-world event that would test any financial theory. The diary is not a record of past brilliance. Soros is open about his confusion, uncertainty, and mistakes. This honesty is refreshing. He shows how fragile our understanding can be, even when we've studied something deeply. I had great difficulty in formulating a coherent view. My thoughts were contradictory, and I kept changing my mind. This raw honesty forms the essence of Soros's worldview. We are all working with incomplete information, and we must adjust constantly. Lightbulb key themes in the experiment. 1. The role of uncertainty. Soros admits he rarely feels sure about his positions, but this doesn't stop him from taking action. Instead, he builds flexibility into his approach, adapting quickly when new information appears. He is guided not by confidence, but by a deep understanding of uncertainty. 2. Perception drives trends. One of the best examples of reflexivity is his analysis of the U.S. dollar. At first, market participants believed the dollar would remain strong, and their actions supported this belief, buying the dollar, investing in dollar-based assets, etc. But once policies shifted, especially after the Plaza Accord, perception started to change. As investors anticipated a weaker dollar, they sold it. The act of selling caused the dollar to weaken, which validated the new belief. This is reflexivity in motion. The change in belief created a change in reality, and the change in reality reinforced the belief. 3. Macro investing in action. Soros isn't a stock picker. He's a macro investor, dealing with currencies, economies, interest rates, and geopolitical movements. His diary shows how he synthesizes political decisions, economic data, and investor psychology into trading ideas. For example, he anticipates currency shifts by evaluating political coordination among central banks, analyzing whether the policies are sustainable, and watching how market sentiment evolves in response. Chart increasing trade examples and decision-making. One fascinating aspect of this chapter is how Soros navigates his positions. The dollar. He initially believes the dollar will fall, but he's unsure of the timing. He shifts between bullish and bearish stances as new events unfold. German bonds. Soros sees an opportunity in German interest rates, based on expected reactions from the Bundesbank, Germany's central bank. But again, his stance evolves. He repeatedly enters and exits positions. Sometimes he's wrong, but what stands out is his ability to cut losses quickly and shift strategies. This flexibility is a hallmark of his investment style. Brain lessons from the experiment. 1. Admit what you don't know. Most investors crave certainty. Soros thrives in uncertainty. He knows that being wrong is part of the process. The key is to stay humble, stay liquid, and stay ready to adapt. 2. Success comes from understanding trends, not predicting them. Soros doesn't pretend to predict the future with precision. Instead, he looks for asymmetries, where perception has diverged from reality, and waits for those gaps to close. 3. Market behavior is reflexive, not rational. Throughout the diary, we see how markets move not purely on data, but on interpretations of that data, often distorted, biased, or emotionally driven. Hammer and wrench, practical applications. Let's turn Soros's experiment into practical tools you can use. Counterclockwise arrows button 1. Keep your own financial journal. Try documenting your thoughts and emotions when making investments or financial decisions. This helps reveal patterns in your thinking and can make you aware of biases before they cost you money. Chart decreasing 2. Don't fear being wrong. Fear staying wrong. Soros changes his mind frequently. If a thesis no longer makes sense, exit quickly. Don't marry your positions. This is a key to long-term survival in volatile environments. Puzzle piece 3. Understand macro factors. Even if you're a stock investor, understanding macroeconomic shifts like interest rates, currency movements, and government policy can provide powerful context. Brain 4. Think in probabilities, not absolutes. Soros rarely bets with 100% certainty. Instead, he operates on likelihoods and risk-reward asymmetries. Ask yourself, if I'm wrong, how much can I lose? If I'm right, how much can I gain? This chapter is where philosophy meets reality. Soros doesn't just preach reflexivity, he lives it. His financial diary shows that the market is not a math problem to be solved, but a living organism shaped by human belief, fear, and hope. The theory of reflexivity, tested in this real-time experiment, proves to be more than just a clever concept. It's a working model of the financial world, where truth and perception are always dancing, never fully in sync. In the chapters ahead, Soros deepens the theory and uses more historical and personal examples to challenge traditional economic thought. We'll also explore his critique of market equilibrium and classical economics, and why embracing uncertainty might just be the most rational move you can make. Chapter 3. Reflexivity in the Stock Market. In Chapter 3 of The Alchemy of Finance, George Soros zooms in on the stock market to illustrate how his theory of reflexivity applies not just to currencies and macroeconomics, but also to individual stocks and equity markets. The central question Soros poses in this chapter is simple, yet profound. Can stock prices influence the fundamentals they are supposed to reflect? Traditional finance says no. According to classical models like the efficient market hypothesis, stock prices are a reflection of the underlying value of companies, derived from earnings, assets, and growth potential. But Soros challenges this with a bold yes. He argues that stock prices can shape company fundamentals, especially when rising prices affect access to capital, investor sentiment, and business expansion. Let's break this idea down. Repeat button how reflexivity works in the stock market. Imagine a company whose stock price starts rising, not necessarily because of stronger fundamentals, but perhaps due to speculative interest or bullish market sentiment. As the stock climbs, the company can raise capital more easily. It may attract more media attention and investor interest. Management may become more confident, accelerating hiring or expansion. Credit becomes more available because lenders view the company as more stable. All these effects feed back into the company's actual performance, making the originally inflated valuation seem justified after the fact. This is reflexivity in motion, perception shaping reality, which then reinforces the perception. Eventually, the illusion may break, but not before real effects have occurred. Chart decreasing case studies and historical parallels. While Soros doesn't cite specific company names in this chapter, the dot-com bubble or even Tesla's meteoric rise in recent years serve as real-world parallels to his argument. High stock valuations allowed tech firms to burn capital, expand operations, and dominate narratives, which attracted more investors. In some cases, the speculation built real advantages. In others, it led to overreach and collapse. Soros calls this the boom-bust process, a defining pattern of reflexivity in equity markets. Lightbulb key lessons from Chapter 3. Stock prices are not just passive indicators. They can become active agents in shaping business outcomes and investor psychology. Bull markets create their own fuel. Rising prices attract more capital, which improves company performance, until reality fails to keep up. The line between fundamentals and perception is blurry. You must learn to see the feedback loops, not just the financials. Hammer and wrench practical applications. Spot reflexive booms early. Look for stocks gaining momentum without fundamental justification. Then watch for signs the narrative is being reinforced by reality. Be cautious of overconfidence. If you invest in a rising stock, ask, is this company really growing Or is the rising price just enabling temporary expansion? Don't blindly trust the market's verdict. Prices don't always tell the truth. Sometimes they create it. Chapter 3 expands Soros's vision of reflexivity beyond currencies into the heart of equity markets. It challenges us to rethink how companies grow, how bubbles form, and how fragile the connection between price and value really is. In the next chapter, Soros turns his attention to a broader critique of classical economic theory and what it gets dangerously wrong. Stay with us on Audio Growth Library as we continue unlocking the wisdom behind the alchemy of finance. Chapter 4. The concept of reflexivity in the context of the credit and regulatory cycle. In Chapter 4 of The Alchemy of Finance, George Soros dives deeper into the theory of reflexivity, this time applying it to a vital area of the financial system: credit markets and regulatory policy. Soros argues that the reflexive interaction between borrowers, lenders, regulators, and markets often creates cyclical distortions that are both amplified and prolonged by policy decisions. These distortions eventually result in credit booms and busts, often with severe economic consequences. Repeat button reflexivity and the credit cycle. At the core of this chapter is a key insight. Credit is based not only on facts, but on expectations. Banks and lenders issue credit based on perceived risk. But that risk perception is influenced by current economic conditions, which are themselves affected by how much credit is available. Here, Soros shows the reflexive loop. Good times lower perceived risk, more lending. More lending asset price inflation and expansion. Asset inflation validates previous optimism. Eventually, credit overextension defaults panic. It's not just a straight line. It's a self-reinforcing loop until it breaks. Straight ruler regulation as a reflexive force. Soros critiques how regulators, though tasked with managing stability, often act procyclically, reinforcing trends rather than moderating them. For instance, during boom times, banks report healthy balance sheets. Regulators ease oversight. Lending expands. During busts, panic leads to tighter regulations. Credit contracts precisely when it's most needed. This, Soros argues, is a policy flaw. Regulation needs to be countercyclical, not reflexively reactive. Regulations are often based on prevailing beliefs and market conditions, which are themselves shaped by market realities the regulations seek to govern. Lightbulb key lessons from Chapter 4. Credit is not neutral. It doesn't just follow growth, it drives it. Access to credit inflates markets, distorts perceptions, and reshapes fundamentals. Risk perception is subjective. What lenders think is safe or dangerous is shaped by the mood of the market, not just data. Regulators often arrive too late. Policy responses typically trail behind market movements, making crashes worse. Hammer and wrench practical applications. Watch credit expansion as an early signal. Excessive credit growth is often a precursor to bubbles. Track credit to GDP ratios, consumer debt levels, and bank leverage. Expect delayed regulation effects. Don't assume regulation will save markets. Often, it tightens conditions after damage is done. Use the cycle to your advantage. Buy when credit tightens irrationally, and be cautious when credit is cheap and abundant. Chapter 4 reveals another dimension of Soros's reflexivity, showing that credit and regulation aren't stabilizing forces, but deeply human systems driven by belief, emotion, and delay. This is a powerful message for any investor. The system is not self-correcting. It's self-reinforcing until crisis hits. In the next chapter, Soros takes on the theoretical heart of economics itself, questioning the validity of equilibrium thinking and rational expectations. Stay with us as we journey deeper into the alchemy of financial reality, here on Audio Growth Library. Chapter 5, The Equilibrium Myth. In Chapter 5 of The Alchemy of Finance, George Soros takes a direct shot at the very heart of classical economic thinking, the idea of market equilibrium. This chapter is a philosophical and analytical critique of the dominant economic theory that assumes markets tend toward a natural, self-correcting balance. According to Soros, this belief in equilibrium is not only flawed, It's dangerous when used to model real-world behavior. Balance scale. What is the equilibrium theory? Classical economics assumes that in a free market, supply and demand interact in such a way that they naturally find a balance, a stable point of rest known as equilibrium. In this framework, individuals act rationally. Prices reflect all known information. Markets correct themselves when mispricings occur. Soros sees this as a myth, a useful fiction, but a dangerous one when taken literally. The assumption that markets tend toward equilibrium ignores the role of imperfect knowledge and the influence of participants on the system itself. Counterclockwise arrows button, the problem with equilibrium. Soros argues that equilibrium assumes a separation between observation and reality, much like in physics. But in finance, participants don't merely observe the market. They shape it through their decisions. Markets are not static systems governed by fixed laws, but dynamic systems influenced by human behavior. Reflexivity, in contrast to equilibrium, acknowledges this constant interaction between perception and outcome. Soros also criticizes how equilibrium theory underpins much of modern finance, including the efficient market hypothesis, rational expectations theory, and many risk models. When markets behave irrationally, traditional economists label these moments as anomalies. Soros flips that idea. Irrationality is the norm, not the exception. Lightbulb key lessons from Chapter 5. Equilibrium is a flawed metaphor. Markets are not machines returning to balance. They are complex adaptive systems shaped by uncertainty, emotion, and shifting expectations. Models oversimplify reality. Most economic models ignore reflexivity, which means they fail to predict or explain crises, bubbles, and panics. Understanding behavior is more important than modeling outcomes. Human decisions drive financial markets, and those decisions are rarely rational or stable. Practical applications. Don't rely on efficient market assumptions. Look for mispricings caused by crowd behavior, narratives, and emotion, not just numbers. Beware of rigid models. Use frameworks, not formulas. Be flexible, especially when real-world events diverge from what theory predicts. Factor in reflexivity during uncertainty. Ask how current beliefs are shaping outcomes, and how outcomes are feeding back into belief. Chapter 5 is Soros's intellectual rebellion. He's not just tweaking economics. He's tearing down its foundations and rebuilding it around uncertainty, imperfection, and feedback. For the modern investor, the lesson is clear. The map is not the territory. Just because a model says something should happen doesn't mean it will. Understanding human behavior and your own biases is far more valuable than any equation. Chapter 6, the credit and regulatory cycle. In Chapter 6 of The Alchemy of Finance, George Soros expands on themes he introduced earlier, particularly the reflexive nature of credit markets, and dives deeper into how credit expansion and regulation interact to shape boom-bust cycles in the economy. Soros now draws a clearer picture of what he calls the credit and regulatory cycle, a phenomenon where policy, sentiment, and credit growth move through predictable yet destabilizing phases. Bomb the cycle of boom and bust. Soros emphasizes that credit is inherently unstable. Why? Because lending is based not just on present fundamentals, but on expectations about the future, which are always subject to human bias. Here's how the reflexive cycle typically unfolds. Optimism leads to increased lending. Easy credit fuels rising asset prices and economic expansion. Higher asset values validate earlier optimism. Lending standards loosen further. Eventually, the expansion overshoots reality. Defaults increase. Panic sets in. Credit tightens abruptly. Regulators step in, usually too late. Soros warns that the regulatory response is often reactive, meaning it reinforces the downturn instead of softening it. He argues that both credit creation and regulation are driven by reflexive forces, each amplifying rather than stabilizing the cycle. Balance scale regulation is not a neutral force. Soros challenges the notion that regulation can provide stability if applied with discipline. In reality, Regulators are often behind the curve. Their decisions are influenced by recent market events and public sentiment, meaning regulation tends to be pro-cyclical, not counter-cyclical. When banks are flush with cash, regulation loosens. When crisis hits, regulation tightens, exacerbating the damage. Rather than smoothing the cycle, regulation often amplifies it. Lightbulb key lessons from Chapter 6. Credit cycles are inherently unstable. They are driven by beliefs and expectations, not objective conditions. Booms build on themselves. Rising asset prices and easier credit feed each other until the system becomes overextended. Regulatory responses lag behind. Policies are often made in hindsight, reinforcing volatility instead of preventing it. Hammer and wrench practical applications. Use the credit cycle as a macro signal. Watch for signs of overleverage or excessive optimism. These are often precursors to correction. Don't count on regulators to protect you. Risk management is your responsibility. Governments and banks typically act too late. Adjust your strategy with the cycle. In boom phases, be cautious of euphoria. In busts, seek undervalued opportunities others fear. Chapter 6 reinforces one of Soros' central beliefs. The economy is not self-regulating, and neither are markets. They are deeply human systems, flawed, emotional, and prone to overreaction. Credit and regulation, rather than providing balance, often throw fuel on the fire. If you understand the rhythm of the credit and regulatory cycle, you can begin to anticipate danger when others feel safe and find value when others panic. Chapter 7. Anticipation and Feedback. In Chapter 7 of the Alchemy of Finance, George Soros explores how anticipation and feedback drive market behavior, delving deeper into the mechanics of reflexivity from a psychological perspective. Soros argues that financial markets are not governed by pure facts or data. Instead, they are driven by expectations, how participants anticipate the future, and how those expectations feed back into the present reality. This chapter shifts from macroeconomic themes to the behavioral side of investing, focusing on how individual and collective anticipations shape outcomes. Crystal ball markets are forward-looking, but imperfectly. Traditional theory holds that markets are efficient because they discount the future. That is, they incorporate all available information about what's coming. Soros challenges this. While it's true that markets try to anticipate the future, their vision is blurred by human bias. The act of anticipating the future affects the present state of affairs in a way that renders genuine prediction impossible. In other words, the moment participants act on their expectations, they change the future they were trying to predict. This paradox sits at the heart of reflexivity. What you believe influences what happens, and what happens reshapes what you believe. Repeat button feedback loops in action. Soros identifies two types of feedback. Self-reinforcing, positive when expectations lead to behavior that makes those expectations come true. Example, a bullish forecast causes buying, which drives prices up, validating the forecast. Self-correcting, negative when behavior undermines the initial expectation. Example, anticipation of inflation causes higher interest rates, which slows the economy and reduces inflation. Most economic models assume feedback is negative, leading to equilibrium. Soros argues that positive feedback is more common in real markets, leading to booms, busts, and instability. Key lessons from Chapter 7. Expectations are not neutral. What people expect will happen actually alters market outcomes. Feedback can amplify errors. When false assumptions are reinforced, they can grow into major distortions or bubbles. Prediction is a moving target. Because markets react to predictions, no forecast remains static. Today's actions reshape tomorrow's reality. Hammer and wrench practical applications. Question the crowd. When a trend seems too good to be true, ask, is this based on real value or just an echo of collective anticipation? Look for accelerating feedback. Rising prices, bullish media coverage, and increased investor inflows are signs of positive feedback. These trends can go further than logic allows, but they always reverse. Be flexible with your forecasts. Don't lock yourself into one outcome. Update your view as the market evolves. Soros' strength lay not in being always right, but in being quick to adapt. Chapter 7 uncovers one of the most overlooked forces in finance: the reflexive feedback between what we think and what actually happens. Soros makes a compelling case that markets are not about prediction, but about interpretation. The best investors are not fortune tellers. They are flexible thinkers who adapt to shifting realities. As we move into the next chapter, Soros further develops this theme, connecting investor behavior with price patterns and offering deeper insights into how market narratives take hold. Chapter 8. Reflexivity in the Currency Market. In Chapter 8 of The Alchemy of Finance, George Soros narrows his focus to the currency markets, a domain where reflexivity is perhaps most vivid and powerful. While earlier chapters explored macroeconomics and general market behavior, this chapter dives into foreign exchange, FX, and how currencies are shaped not just by economic fundamentals, but by expectations, speculation, and government intervention. Currency exchange, currency markets, where belief meets policy. Currency values are typically explained using interest rate differentials, trade balances, and inflation expectations. But Soros points out that these are only part of the story. What truly drives exchange rates is the market's belief about those fundamentals, and how that belief affects policy decisions. Here's where reflexivity comes into play. Investors form expectations about future monetary policy. They act on those beliefs, buying or selling a currency. Their actions influence interest rates, inflation, and even central bank behavior. This feedback alters the very fundamentals they tried to anticipate. Currency values are not determined solely by objective conditions. They're shaped by reflexive interaction between policies and market expectations. Repeat button, the dollar, and reflexive cycles. Soros uses the US dollar as a case study. In the 1980s, the dollar appreciated rapidly due to tight monetary policy and high US interest rates. This capital inflow drove up the dollar's value, even beyond sustainable levels. As the dollar rose, exports weakened, trade deficits ballooned, economic fundamentals worsened. Eventually, reality contradicted the optimistic perception, and the dollar collapsed. This is a classic reflexive cycle. Perception drives value, which distorts fundamentals, leading to reversal. Soros emphasizes that currency markets are especially prone to overreaction because they're global and liquid. They're heavily influenced by short-term speculation. Governments often respond to currency movements with reactive, not proactive, policies. Lightbulb key lessons from Chapter 8. Currency values are reflexive, not rational. Prices reflect a mixture of fundamentals, speculation, and policy response, all influenced by perception. Expect overshoots and reversals. Currencies often move too far in one direction before correcting, especially when markets fixate on a single narrative. Governments influence, then follow markets. Policymakers often react to market pressures, inadvertently reinforcing market trends until they break. Hammer and wrench practical applications. Look for divergence between perception and fundamentals. When a currency rises despite worsening trade or fiscal data, it may be driven by temporary optimism, setting up a potential reversal. Monitor central bank signals. Currency movements can trigger policy changes. Reading between the lines of official statements can give clues to impending shifts. Ride trends carefully, but exit before reflexivity snaps. Currency trends can last longer than fundamentals justify, but reversals can be sharp. Stay nimble. In Chapter 8, Soros gives us a clear look at how reflexivity plays out in real time, especially in the high-stakes, fast-moving world of currencies. The takeaway is simple but profound. Perception moves money, and money moves policy. Currency markets are not just economic. They're psychological, political, and reflexive. Understanding this can give you a critical edge. Chapter 9. International Debt and International Wealth. In Chapter 9 of The Alchemy of Finance, George Soros shifts the conversation toward a global scale, tackling the complex relationship between international debt and international wealth. This chapter explores how global financial imbalances arise, not just from trade deficits, but from the way debt, credit, and capital flow across borders. Soros shows that even international finance is reflexive. What we believe about a country's debt sustainability shapes capital flows, exchange rates, and ultimately, that country's economic reality. Globe showing Europe-Africa debt and wealth aren't equal and opposite. A key insight Soros emphasizes is that international debt and wealth are not mirror images. While conventional thinking sees one country's debt as another's asset, Soros shows that this symmetry breaks down during crises. Why? Because the perceived value of assets depends on confidence. When a debtor country struggles to repay, creditors may panic and sell, reducing the value of their own holdings. As a result, international wealth can evaporate far more quickly than debt obligations disappear. This creates a fragile system. When global sentiment shifts, the destruction of wealth is often sudden and severe, leading to debt crises, capital flight, and economic collapse. Bomb case study: Latin American debt crisis. Soros uses the Latin American debt crisis of the 1980s as a vivid example. During the boom years, Western banks lent heavily to countries like Mexico, Brazil, and Argentina. These nations borrowed aggressively, often with the belief that growth would cover repayments. But once commodity prices fell and interest rates rose, the narrative changed. Lenders began to doubt repayment capacity. Capital flows reversed. Panic ensued. The crisis became self-reinforcing. This is reflexivity in international finance. Expectations changed, which altered reality, which in turn justified the original fears. When the mood changes, the discrepancy between debt and wealth becomes visible. Key lessons from Chapter 9. Debt and wealth are not symmetrical in times of crisis. The collapse of confidence can destroy perceived wealth faster than debt can be restructured or repaid. Global finance is deeply reflexive. International lending is based on narratives as much as numbers, and when those narratives break, so do economies. Crises are self-reinforcing, not self-correcting. Once panic sets in, both creditors and debtors act in ways that deepen the crisis. Hammer and wrench practical applications. Monitor sentiment, not just data. In global investing, shifts in confidence can matter more than fundamentals. Watch credit spreads, capital flows, and central bank tone. Avoid debt-fueled booms without structural support. If a country grows mainly through borrowing, the boom is likely unsustainable. Diversify across regions. Global finance is interconnected. A debt crisis in one region can ripple through asset classes worldwide. Chapter 9 makes one thing clear. Global finance is a house of mirrors. Capital moves not just in search of value, but in search of stories. And when those stories unravel, the damage can be massive and immediate. Understanding the reflexive relationship between debt and wealth on a global scale can help investors better navigate international markets and avoid the pitfalls of herd-driven lending and panic-driven withdrawals. Chapter 10. Investing and Reflexivity. In Chapter 10 of The Alchemy of Finance, George Soros takes his deep philosophical and economic theories and applies them to the craft of investing. This chapter serves as a bridge between Soros's conceptual framework of reflexivity and his real-world trading and portfolio management strategy. He reveals how his ideas are not just academic. They directly shape how he takes and exits positions. Investing is not just about analysis, it's about influence. Most investors try to analyze data to predict market behavior, but Soros flips this on its head. He asserts that investors are not outside observers. They are participants whose actions help shape market outcomes. The participants' decisions are based on their expectations, which are influenced by market developments that are themselves shaped by those decisions. This makes investing a two-way street. You act based on what you believe the market will do, but your action and the actions of others move the market, changing the outcome you are trying to predict. This feedback loop is the essence of reflexivity in investment practice. Repeat button Soros's trading philosophy. Soros reveals several key ideas that guide his investment strategy. Fallibility. No investor is ever 100% right. Soros embraces uncertainty, which makes him quick to cut losses when wrong and press bets when right. Feedback loops. He constantly reassesses his positions based on how markets evolve. If price action begins to reflect his thesis, he doubles down. If not, he exits. Boost recognition. Soros looks for situations where misperceptions are driving price trends. If the narrative is causing real changes in fundamentals, it can trigger a self-reinforcing trend, a bubble he might ride, then short at the top. Briefcase case study. Identifying market misperceptions. Soros discusses how he watches for situations where market consensus diverges from reality, especially when that misperception is causing price movement. For example, a country may be seen as safe, attracting capital, but if its debt levels or political risk rise quietly in the background, that optimism is misplaced. When the truth emerges, a rapid correction follows. Soros profits by recognizing the gap between perception and reality before others do. Key lessons from Chapter 10. Markets are shaped by the people in them. Your investment decisions influence the very system you're trying to predict. Admit when you're wrong. Soros sees fallibility as a strength. Flexibility is more important than conviction. Look for self-reinforcing trends. When misperception changes reality, like bubbles or panics, there's opportunity to profit on the way up and protect on the way down. Hammer and wrench practical applications. Keep a trading journal. Like Soros's own financial diary, record your thoughts behind each trade. Reassess often. Don't seek perfect knowledge. Seek actionable insight. Wait for alignment between your thesis and market behavior. Then move decisively. Ride trends, but watch for breaking points. Reflexive cycles often go further than expected, but they always end. Prepare for the reversal. Chapter 10 gives us a rare look at how theory becomes profit. Soros's brilliance isn't just in his intellect. It's in his ability to translate abstract concepts into decisive, adaptive action in the market. This chapter is essential for any investor looking to move beyond rigid models and into a more fluid, behavioral understanding of financial systems. Chapter 11. The Quandary of the Social Sciences. In Chapter 11 of The Alchemy of Finance, George Soros steps back from the financial markets to address a deeper issue: the limitations of the social sciences, especially economics, when applied to human behavior and financial systems. This chapter isn't just theory. It helps explain why so many economic predictions fail and why markets frequently behave in ways that defy rational expectations. Soros's main message is this: the methods of natural science cannot be successfully applied to human affairs. Brain the problem with economics as a science. In natural sciences like physics or chemistry, there are fixed laws that govern the universe. You can run experiments, isolate variables, and predict outcomes with high accuracy. But Soros argues that economics and other social sciences deal with thinking participants, people whose decisions are influenced by incomplete knowledge, emotions, biases, and feedback from the very system they're part of. This makes it impossible to have truly objective or universal laws in social sciences. Economists who try to model human behavior as if it were physics are doomed to oversimplify reality. Repeat button reflexivity makes prediction impossible. Soros reaffirms his theory of reflexivity, showing that people's actions change the environment they're trying to understand. Because of this dynamic loop, forecasts alter outcomes. Models are constantly outdated, and certainty is an illusion. In financial markets, for example, a widely accepted prediction may invalidate itself. If everyone expects a stock to rise and buys in, the price might shoot too high and eventually crash. The prediction leads to its own failure. Collision clash with mainstream economics. Soros critiques several mainstream ideas, particularly rational expectations theory, which assumes individuals make unbiased predictions of the future. Equilibrium theory, which assumes markets always trend toward balance. Soros finds both to be detached from how markets actually behave. He advocates for a more flexible, reality-based approach, one that acknowledges fallibility, feedback, and irrationality. Lightbulb key lessons from Chapter 11. Social sciences are not governed by fixed laws. Human systems are dynamic and uncertain, not mechanical or predictable. Reflexivity makes forecasting inherently flawed. Predictions influence behavior, which changes outcomes, rendering most models unreliable over time. Economic models often create false confidence. They work until they don't, and when they fail, the consequences can be severe. Hammer and wrench, practical applications. Be skeptical of rigid models. Don't blindly trust forecasts or financial formulas. Markets evolve faster than models can keep up. Expect feedback and surprises. Assume your decisions and the crowds will affect the outcome. Use this to your advantage. Learn from other disciplines. Psychology, history, and politics often explain market behavior better than mathematical equations. Chapter 11 is Soros's intellectual critique of traditional economics, a call to embrace uncertainty, fallibility, and feedback as the true realities of human systems. This message matters for every investor, policymaker, and thinker. If your tools assume certainty in a world ruled by uncertainty, you are trading blindfolded. Chapter 12. Macro Trends in the 1980s. A Real-Time Investment Diary. In Chapter 12 of The Alchemy of Finance, George Soros opens his private investment diary from the early 1980s, a unique and bold inclusion in a book of financial theory. Why is this so valuable? Because we get to see how Soros applies reflexivity, fallibility, and feedback loops in real time, during one of the most volatile macroeconomic periods in modern history. No book inside the investor's mind. The diary covers a critical span from August 1985 to February 1986, a period marked by a weakening U.S. dollar, central bank interventions, especially after the Plaza Accord, shifting interest rates and inflation expectations, and geopolitical tensions. Soros lays bare his thoughts, doubts, missteps, and evolving hypotheses. This is not a sanitized account of flawless investing. It's raw, reflective, and brutally honest. I'm not proud of the performance in this period, but the mistakes are instructive. His openness about error is a powerful theme. Soros repeatedly emphasizes that fallibility is a feature, not a flaw, and the key is adapting quickly when reality diverges from expectations. Magnifying glass-tilted left key trades and thought processes. Several insights emerge from his trading decisions. He takes large positions based on macro trends, particularly in currencies, bonds, and interest rate movements. He watches for policy shifts and attempts to front-run their impact on markets. He reacts swiftly to changing sentiment, often reversing course when his thesis begins to lose traction. For instance, Soros initially bets on continued dollar strength, but reverses his position as global pressure builds to weaken the dollar. He is not emotionally attached to a view. His focus is always on staying aligned with evolving reality. Lightbulb key lessons from Chapter 12. The best investors adapt fast. Soros doesn't wait for confirmation. He changes course when market action suggests his thesis is wrong. Markets are narratives in motion. His diary shows that markets respond to stories about policy, growth, inflation, not just hard data. Risk is managed through humility. Soros rarely holds onto losing positions out of pride. He accepts error as part of the game. Hammer and wrench, practical applications. Maintain your own investment journal. Track your decisions, your logic, and the actual outcomes. It builds self-awareness and disciplines your thinking. Stay flexible, not dogmatic. If the market is telling you you're wrong, listen. Being early is the same as being wrong if you can't survive the wait. Follow macro signals. Monitor central bank behavior, global capital flows, and political shifts. They shape the environment more than earnings reports. Chapter 12 isn't just a diary. It's a masterclass in mental flexibility. It shows Soros in the trenches, wrestling with uncertainty, managing massive positions, and applying his theories in real time. Chapter 13, Real-Time Experiment Continued, Adapting Through Uncertainty. In Chapter 13 of The Alchemy of Finance, George Soros continues sharing his investment diary, offering readers a unique glimpse into how one of the world's greatest investors navigates shifting markets in real time. Spanning the second half of his 1985 to 1986 journal, this chapter is not just about numbers and trades. It's about the psychology of investing under pressure and the ability to adapt while staying grounded in macro themes. Chart increasing learning while investing. What makes this chapter stand out is that Soros isn't just making decisions. He's learning from them as he goes. He revisits his assumptions frequently and isn't afraid to admit when they no longer hold up. This is a living application of reflexivity and fallibility, his two core principles. Reflexivity. The market is shaped by the actions of participants, including himself. Fallibility. He constantly questions his own judgments, understanding that being wrong is inevitable. One standout reflection in this chapter. The key is not whether you're right or wrong, but how much money you make when you're right and how much you lose when you're wrong. This mindset is what separates a gambler from a great investor. Money with Wings' big themes: dollar decline, global policy, market sentiment. During this period, Soros continues to trade macro themes. He observes the declining U.S. dollar after the Plaza Accord, where global governments agreed to weaken the dollar. He anticipates interest rate cuts and positions himself in long bonds. He watches Japan and Germany's monetary policies closely, using them as signals for global capital flows. But the brilliance lies not in his initial theses. It's in his willingness to revise them constantly. When the market doesn't move as expected, he doesn't rationalize. He reassesses. Key lessons from Chapter 13. Adaptability is a superpower. Soros doesn't hold on to ideas that stop working. He lets go quickly and repositions. Real-world trading involves constant tension. Emotional control and disciplined thinking are essential when managing risk at scale. Reflection strengthens judgment. His investment diary isn't just a record. It's a tool for improving thought quality and market insight. Hammer and wrench practical applications. Use feedback to evolve. Track your market assumptions and how they play out. Be honest with yourself about what worked and why. Focus on asymmetric bets. Like Soros, look for trades where the upside far outweighs the risk, and exit quickly if the setup changes. Avoid ego investing. Detach your identity from your ideas. What matters isn't being right. It's being profitable and survivable. Chapter 13 shows that great investing is as much mental as it is technical. Soros treats the market like a conversation, listening carefully, responding with humility, and never falling in love with his own opinions. He brings together real-world data, global events, policy shifts, and emotional clarity in a way few others do. As we near the end of the Alchemy of Finance, Soros will begin tying these lessons together, forming a complete philosophy that goes far beyond money. Chapter 14. The results and their meaning. In Chapter 14 of The Alchemy of Finance, George Soros steps back from his investment diary to analyze the results of his real-time experiment. But rather than simply celebrate profits or dissect trades, Soros uses this chapter to extract deeper meaning, both about the markets and his unique approach to navigating them. Bar chart: the real-time experiment, success and self-awareness. Soros begins by reviewing the outcomes of the trades chronicled in the previous chapters. He acknowledges both successes and mistakes. His long bond positions, short dollar bets, and global macro themes produced significant profits. But, true to his core philosophy of fallibility, he doesn't focus on being right. Instead, he emphasizes the value of staying open, reflective, and adaptive. I may not always be right, but I am quick to recognize my mistakes. This self-awareness, more than any single trade, is what allows him to succeed over the long term. Collision trading versus investing, a mental game. Soros reiterates that successful investing isn't about having superior information. It's about being able to process uncertainty, navigate ambiguity, and respond to feedback faster than the crowd. This is where reflexivity becomes a competitive edge. Most investors believe markets reflect reality. Soros acts on the belief that markets create reality through the actions and biases of participants. counterclockwise arrows button, understanding reflexive cycles. Throughout this chapter, Soros reviews how reflexive cycles played out in real time. The US dollar weakened after market sentiment shifted and policy aligned with new expectations. Bond markets reacted not just to fundamentals, but to investor beliefs and Fed signaling. Narratives drove capital flows more than data did. These examples validated his theory. Market perceptions influence fundamentals, not just the other way around. Lightbulb key lessons from Chapter 14. It's not about being right. It's about being responsive. The market rewards those who can adjust quickly, not those who cling to being correct. Profits follow process. By constantly reassessing beliefs and staying humble, Soros stayed aligned with changing market conditions. Market narratives matter. Shifts in sentiment often precede shifts in data, so watching the crowd's mood can provide an edge. Practical applications. Develop a feedback loop in your strategy. Don't just track outcomes. Track your reasoning and refine it often. Watch the interplay between policy and perception. Government statements, central bank moves, and geopolitical developments can change market sentiment instantly. Be a probability thinker. Instead of looking for certainty, assess odds. A high probability setup doesn't guarantee success, but it gives you the best chance. Chapter 14 is a masterclass in investing as an adaptive, real-time discipline. Soros shows that success doesn't come from prediction, but from responsiveness. He uses theory not to forecast, but to frame the chaos of the markets in a way that allows for consistent, flexible action. Chapter 15. The Theory of Reflexivity. In Chapter 15 of The Alchemy of Finance, George Soros returns to the cornerstone of his worldview, reflexivity, but this time he steps far beyond finance. This chapter is the intellectual climax of the book, where Soros presents reflexivity as a general theory of human behavior, not just a market mechanism. He proposes that all human systems, markets, politics, history, and even science, are shaped by feedback loops between perception and reality. Brain reflexivity, a universal concept. Soros redefines reflexivity as a system where participants form biased views of reality. These views influence their actions, and their actions change reality, which, in turn, reshapes their perceptions. This loop never resolves into perfect knowledge or balance. Instead, it creates a moving target, a constantly shifting interplay between thinking and being. We live in a world that we help to shape, and our understanding of the world is part of the world we seek to understand. This insight stands in stark contrast to traditional science, which assumes the observer is separate from a system. In human affairs, Soros argues, the observer is always a participant. Chart decreasing, why economics fails. Soros critiques economics as a field that tries to mimic physics, assuming people are rational and markets are self-regulating. But reflexivity suggests otherwise. Expectations influence outcomes. Systems evolve unpredictably, and equilibrium is more fantasy than fact. This explains market bubbles, financial panics, political revolutions, and social movements, all phenomena where perception shifts reality. Globe showing Europe, Africa, beyond finance, society, politics, and knowledge. Soros broadens reflexivity into several domains. Politics. Ideologies don't just describe the world. They shape policies that transform it, for better or worse. Social science. Theories in sociology or economics are themselves part of the system they study, unlike physical laws. Philosophy. He challenges the idea of objective truth in social affairs, proposing instead a theory of imperfect understanding. This imperfect understanding creates a world where stability is temporary and uncertainty is permanent. Lightbulb key lessons from Chapter 15. All human systems are reflexive. Our beliefs about the world change the world itself, especially when those beliefs are widely shared. Knowledge is imperfect and provisional. We never have complete clarity. The goal is not certainty, but agility. Rigid models fail in dynamic systems. Especially in economics and politics, frameworks must evolve with changing realities. Practical applications. Stay skeptical of laws in social sciences. Treat models as tools, not truths. Be ready to revise them as the world shifts. Understand the power of narrative. Ideas and stories can reshape markets, societies, and histories. Track sentiment and collective belief. Think like a participant, not a spectator. In investing, politics, or business, you're part of the system. Your choices influence outcomes. Chapter 15 is Soros at his most philosophical and far-reaching. He's not just offering a financial framework. He's presenting a worldview. Chapter 16, The Quandary of the Social Sciences, Revisited. We've now arrived at the final chapter of the Alchemy of Finance. And in true Soros fashion, Chapter 16 does not end with investment advice, but with a call for philosophical clarity and moral responsibility. Here, Soros revisits the problems of the social sciences and reaffirms his belief that economics, politics, and finance cannot be understood through detached objectivity. Instead, they're deeply human systems, shaped by values, influenced by perception, and governed by fallibility. Puzzle piece science versus human affairs. Soros opens the chapter by comparing natural sciences to social sciences one last time. Natural sciences rely on hard laws and reproducible experiments. In contrast, social sciences are messy. Human beings observe, interpret, participate, and change the very systems they try to understand. This makes prediction inherently unstable in economics, politics, or markets. As Soros puts it, social theories do not describe a reality that exists independently of the theories themselves. This is not just an intellectual point. It has ethical consequences, brain fallibility, and moral responsibility. Because we operate within systems we influence, Soros believes we also bear responsibility for our actions. He proposes that reflexivity leads not just to uncertainty, but to a need for personal accountability. Investors affect markets. Politicians shape public behavior. Citizens influence government decisions. Recognizing this, Soros urges us to act with self-awareness and moral intent. He opposes the view that market participants are absolved from responsibility simply because they follow incentives. In his view, that's intellectually lazy and ethically dangerous. Freedom, democracy, and open society. Soros connects his theory back to his broader political philosophy, especially the idea of the open society, which he adopted from philosopher Karl Popper. An open society is one that accepts fallibility as inevitable, encourages critical thinking and freedom of thought, and adapts to feedback from its citizens and institutions. In contrast, closed systems, whether in authoritarian politics or rigid economic dogma, pretend to have all the answers. These systems resist change, punish dissent, and ultimately collapse under their own illusions. Soros believes that freedom and uncertainty are two sides of the same coin. You can't have one without accepting the other. Lightbulb key lessons from Chapter 16. Human systems resist fixed truths. Any theory about society must evolve because society itself evolves. Responsibility matters. In reflexive systems, your actions have ripple effects. Whether you're a trader or a citizen, you're not a passive observer. Freedom thrives on fallibility. An open society is one that can admit mistakes, learn from them, and course correct. Hammer and wrench, practical applications. Act with intention in all domains. Investing, politics, and personal behavior are not isolated. Your decisions shape outcomes. Challenge dogma. Whether in finance or ideology, always leave room for error and revise your views when reality shifts. Support open systems. Encourage transparency, diversity of thought, and feedback. These are the safeguards against destructive certainty. Chapter 16 is the perfect close to the alchemy of finance. Soros' legacy isn't just about building one of the most successful hedge funds in history. It's about shaping a worldview where uncertainty is embraced, truth is pursued with humility, and power is exercised with responsibility. Through reflexivity, Soros teaches us not only how to understand markets, but how to think deeply about our role in the systems we inhabit. And that brings us to the end of The Alchemy of Finance by George Soros, one of the most insightful, challenging, and thought-provoking journeys through the mind of a true financial philosopher. Over 16 powerful chapters, we've uncovered not just strategies for navigating markets, but a new way to think about uncertainty, risk, success, and responsibility. From reflexivity in global finance to the moral implications of our actions in society, Soros has shown us that understanding the system means understanding ourselves. If you've made it this far, thank you, truly. You're not just a passive listener. You're part of a growing community that believes in learning deeply, thinking critically, and acting intentionally. Books, if you found value in this audiobook-style summary, please like the video to let us know it helped you. Subscribe to Audio Growth Library for more in-depth summaries of the best financial and personal development books ever written. Share this with someone who's passionate about investing, economics, or simply expanding their thinking. Speech Balloon, we'd love to hear from you in the comments. What was your biggest takeaway from the alchemy of finance? How has Soros' theory of reflexivity changed the way you see the world? Backhand index pointing down if you're hungry for more. Check out our full playlist of financial wisdom. From the intelligent investor to the millionaire fast lane, we've got you covered. This is Audio Growth Library, where every chapter brings you closer to clarity, confidence, and control over your financial life. Until next time, keep growing.